Welcome back to another video. Today we're going to be talking about mastering your psychology and how to master your emotions as a trader. Traders' brains release more dopamine during volatile markets than a gambler in a casino. Emotions like fear, greed, and excitement affect your decision making. Impulsive decisions often lead to losses, according to a study. And a real-life example of this was the 2008 financial crisis, where traders were driven by fear. So it's very important that you guys understand why your emotions matter in trading and how it can affect how you trade. The fight or flight response in trading. Running from a bear is smart, but running from a bear market can cost you big. The brain's survival instincts kick in during market volatility, and the amygdala hijacks logical reason, causing fear-based trades. The amygdala is a part of your brain that is in charge of emotional processing, motivation, memory, survival, and your social anxiety. You need to understand the fight or flight response. You need to be able to understand what you see, what you control, and what you can and can't control. There's a TED Talk by Daniel Goleman. Goleman is really known for talking about emotional intelligence, and he often compares it to your IQ. Emotional intelligence is the ability to identify, assess, and control one's emotions. When you hold on to a sinking stock, it's like rearranging chairs on the Titanic. What do I mean by that? You're helping something you can't help. So greed leads to over-leveraging, chasing losses, or holding losing positions. An example was the Dotcom bubble when traders held on too long due to greed, and the stock crashed. They lost a lot of money. Greedy traders underperform on average. That is completely normal. Greediness destroys traders today. Stop focusing on the money and just focus on your execution and your risk. If you see the image down here, develop a trading plan, use stop-loss orders, practice patience, manage your expectations, and stay informed. Good things come to those who wait, unless it's a dead stock. Mastering your patience and discipline is very important. Successful traders practice patience and stick to a strategy. Set entry and exit points and respect stop losses. A real-life example of this is Warren Buffett's trading style. He's a long-term investor who is very patient. There's a TED Talk by Kelly that goes over how to make stress your friend. And she goes over how embracing stress can save your life. People who face stressful experiences view them as opportunities for growth and have lower mortality rates compared to people who view stress as harmful. You want to be able to make stress your friend in this situation. You want to be able to have that patience and that discipline to stay in a trade that you believe will work. Using your stop losses and using your take profits will help you become successful as a day trader. Missed the bus? Don't worry, there's another one filled with regret right behind it. That's called FOMO. Overcoming FOMO, or fear of missing out. FOMO pushes traders to jump into trades without proper analysis. An example of this was the GameStop craze. When people bought at the peak of GameStop, when they thought it was going to keep going up, that $20 increase, everyone was super excited. And when it peaked and it dropped, everyone lost a lot of money. Simply because of FOMO. They felt like they were missing out on a big money opportunity. Studies show that FOMO-based trades often lead to losses. So don't trade with FOMO and don't trade with your emotions. Trade with a strategy and trade with rules. Another thing I want to go over is 7 rules I think are very important on this. 1. Understand the impact of impulsive trading. You want to understand why you're buying so fast. You want to understand why you're selling so fast. And you want to understand why you got in. 2. Recognize the triggers and patterns of this impulsive behavior. Why do you keep doing that? What do you see that's making you think that the stock is going to go up? What is leading you to make these impulsive decisions, these quick decisions on these stocks? 3. Set clear trading goals and stick to a trading plan. You must set a clear goal and stick to a trading plan because this will lead to your success, consistency, and a pattern. And I don't mean trading a pattern, I mean pattern and repetition. And just doing something consistently every day will lead to a person's success. 4. Practice patience and avoid rushing into trades. 5. Utilize stop losses and take profit orders. When you're not using this, you're chasing after the money. You're not chasing after the result. 6. Learn from your past mistakes and adapt a growth mindset. 7. Seek support and accountability. Facing losses is a part of the game. What do I have to say about this? I didn't lose a trade, I just bought an expensive lesson on patience. Losses are inevitable, and the key is to accept them and move on. An example of this was Ray Dalio's failures, and he ended up leading one of the largest hedge funds. A quote by Ray Dalio that I looked up was, He who lives by the crystal ball will eat shattered glass. I don't know what that means. Evidence of this is learning from failure can lead to long-term success. Meditation and mindfulness in trading. Meditation helps traders stay calm and reduce emotional reactions. Research shows meditation enhances focus and emotional control. An example of this was billionaire Paul Tudor Jones practices mindfulness for balance. I think that it's very important that you guys have a clear mind when you hop into the market. You shouldn't be happy about a trade, you shouldn't be mad about a trade, and you shouldn't be sad about a trade. If you're still thinking about a previous trade you took a week before, the day before, minutes before, you're not ready for the next trade. Building emotional resilience. Emotional resilience keeps traders from being discouraged after losses, and build resilience through mental training, journaling, and self-reflection. What doesn't kill your portfolio makes it stronger. Those $0 days, or those days you don't trade because of news, those are smart. It's okay to have that $0 day instead of that negative $100 day. In conclusion, trading with the emotions. Mastering your emotions sets you apart from 90% of traders. The key takeaways of this were patience, discipline, mindfulness, and resilience. I said those throughout the video at least 20 times to get that stuck in your head. I don't care how many times I said it, and it might have got annoying, but you guys have to understand I purposefully said it 30 times throughout this video just so it's stuck into your head. Don't let your emotions control your trades, control your emotions to master the market. And the joke was, your trading success is 90% psychology and 10% math. Unless you're bad at math, it's 100% psychology. I do have a Discord. It's completely free, and everything you see right here is all for free. It has a bunch of videos. If you're just getting started, it has literally step by step, and if you guys want to take notes while you do it, it also helps you become better as well. If you guys are interested, the link will be in my bio, and if you guys want more videos like this, I will be dropping some more in-depth tutorials on how to trade. But yeah, if you guys are interested in more videos like this, or if you guys do want to join my Discord, it's going to be the link in bio, and I'll catch you guys on the next one.